Okay, good afternoon and welcome back everyone to our market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and I am joined by a very special guest, Steve Sosnick, the chief strategist at Interactive Brokers, to discuss a little bit about the markets and the current state of options in the Canadian markets. So Steve, first of all, welcome to and a big thank you for taking the time out here today and joining us.
Thanks, Tony. It's always a pleasure to join you. I really enjoy doing these webinars on behalf of TMX and along with you. And let's see how it goes. Should be fun.
I know a lot of you, I know, trade at Interactive Brokers, especially for those of you that trade multi-leg options in Canada. Interactive Brokers, one of the few brokerage firms that offer that. So really excited to have Steve and talk a little bit about options here today. Now, before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So before we get started, Steve, I just want to give you a few minutes to talk a little bit about your background for those of you here on the session who are not familiar with Steve. Steve, you are the chief strategist here at Interactive Brokers. Could you tell us a little bit about your role there, what you're responsible for at Interactive Brokers?
Sure. I come to this job as chief strategist, having been a market maker for options and stocks and options for over 30 years, actually. So it was time for a bit of a change, and also as our firm moved away from a lot of the market making businesses, which was the original role of our firm. Over time, we only became a brokerage firm later on, my role changed along with the firm, and so now the thing I like doing best is educating people about markets, about strategy, about how various asset classes interact, and particularly about how to utilize options to achieve goals of the investor's goals, whether those are hedging, income, or speculation. And notice speculation came last among those three. So that's why I'm always happy to be here. And a big part of my role, I've had a 25-year relationship with TMX, basically, just under 25 years. We started making markets actually my relationship with TMX goes back to the very beginnings of my career, but from an options market making point of view, I made markets in Canadian options for over 20 years. So I think I've got some pretty good knowledge to the market mechanics and the names that are involved. So it's a pleasure to be here. And I just want to note for the audience, Tony came up with the Canadian Rockies virtual background. And I had a picture of my family skiing as in the Canadian Rockies, our virtual background, but I figured I'd balance the boat a little bit. And this picture was taken near the Montmorency Falls in Quebec. And I even got a little maple leaf in there. So, we've got the country spanned now.
Very nice. And we're going to talk about all of those things that Steve referred to, specifically the intermarket analysis, because as many of us that are equity traders, we do still need to look at other markets, everything from interest rates to currencies to commodities. So we're going to talk about all of those things. And Steve, and specifically around options as well. And I especially like, your transition, if you will, from the market making side to the strategist side, because we'll also talk a little bit about some insights that Steve will be able to share with us on, placing orders, because a lot of the responses that I've received from Canadian investors regarding Canadian derivatives is around the spreads and how to trade, options that have wider spreads. So we'll talk a little bit about, the perspective from a market maker, how they look at those spreads and how you as a trader could interact within that quote and still get filled at a price that is significantly better than what is quoted on your screen. So hopefully you're going to be able to take away not only some analysis on the markets and our views, but also some insights into executing some trades within the Canadian markets. So we'll start off with just a broad conversation about the equity markets. The TSX 60 has been doing quite well here after breaking out above that $27 level, which is the all-time high prior to the pandemic. We broke out above that level here just in the beginning, towards the beginning of the year. It failed at the end of the year at these levels, but finally broke out above this in mid-January and has just continued on since, and has been fairly strong and a pretty consistent grind here to the upside, with a few small pullbacks in the 3 to 5% range, but continues to push higher here. In my opinion, stronger than the US markets here right now. Steve, I'd just like to get your thoughts overall as just on the overall Canadian equity markets.
The Canadian markets, benefit in many ways, if not, if, I was going to say indirectly, but directly from the US stimulus. I mean, yes, the biggest stocks in the index are things like Shopify and the banks, but ultimately, global investors still view Canada as a commodities proxy economy. We can argue whether that's right or wrong. I think right now, anyone who would take the opposite side probably shouldn't argue too strongly against it because it's working. And I think if you think about who the likely beneficiaries would be of a global economic rebound, why wouldn't Canada be at the forefront of that, of course?
That's absolutely right. And if you look at the TSX 60, you're dominated by energy names and banks, which have been doing quite well since the election here, and or the U.S. election, that is. And that's where we've seen a lot of the outperformance here in the U.S. And that's where we see the outperformance here in Canada versus the S&P 500. Now, Steve, you sent us a chart here, which I'm going to show here next, which is interesting. You were showing here the change in XIU's implied volatility from from last week to yesterday. And just to give users an understanding, that what we're showing here is the change from the red line to the white line over the past week. So the drop that we've seen in implied volatilities across the entire surface, in terms of the drop in implied volatilities here in XIU. So Steve, could you talk a little bit about what you're seeing from this graph and how you interpret that data?
Sure. It shouldn't come as much of a surprise, to most people who are involved in option markets, that vols would have come down from last week to this week. The rally. The rally is one of those things, especially resulting from an economic number that was boosting implieds a little bit, would normally take a little bit of volatility out of the market. And we can see that the red line going to the white line is basically the volatility that was put in prior to the end of the quarter and ahead of the US payrolls number getting sucked out a little bit. Now, just for those of you who've never looked at volatility this way, let me explain the chart a little bit. You'll notice that the x-axis is percentages. And the reason, those are basically percent of the money. And what that does is, actually highlighted the Y. Yeah, there we go. What that does is it allows you to do a constant comparison. So, as any index or ETF or stock moves, the at money number changes. And so this is a way of viewing skew sort of constantly. So, so it doesn't matter if at money is 20 or 21 or 26. It doesn't really matter. It keeps the skew constant for the range. And that's how I like to do it. It also helps in this case for intermarket comparisons, because you could put things on, that have wildly different index values on the same graph, which in this case is S&P, the same implied volatilities for S&P, looking out over that time. And the y-axis is your implied volatility in annualized terms. So.
And just to be clear, the 100% would represent the at the monies, and the 105s, for example, would represent the strike price that's 5% above the current price. and then 95% would represent the strike price that are 5% below the current price of the stock. That's what we refer to when we talk about moneyness. It's how far in the money an option is, or how far out of the money an option is. So this gives you a great way to compare. So Steve, and what we're seeing here is that the XIU implied volatilities are actually lower now than what we have seen in the S&P 500.
Yeah, and I think that may surprise some people. When you think of the relative stability of the S&Ps, SPX, they both have an S&P in their name somewhere, but SPX versus XIU, that's not necessarily an intuitive result. And one important thing to keep in mind is, we kept the moneyness constant. We're also sort of looking at 1 month out, whatever that may be. Keeping that constant, because of course it keeps the decay normalized too. So 1 month S&P options, the curve for the most part is above that, which is the green line, which was above yesterday. The white line, which was the same 1 month option look for XIU. The reason I like to look at 1 month options is those are the options that make up VIX in the U.S. VIX is comprised, and I won't go into all the details, but call it roughly a constant 30-day look ahead. And so if we can normalize it to 1 month, we're looking in relatively normalized terms. Another thing you'll note is, the numbers can be a little bit different between VIX and SPX, and I don't want to get into that too much. You can read some of the stuff. Here, I'll switch my background so you can see where to find some of the work that I've been doing. I'll change it up in a moment. But they're Interactive Brokers Traders Insight. But basically, what this is telling me is a couple of different things. First of all, you'll notice that the green from, let's say, you'll notice how much steeper the curve is from 105 through about 110, 115. 120 level in the US. That I think has become more of a feature. You'll notice also that the US is a bit lower in the 80% to 90% range. This is because the US curve has been getting more symmetrical. I think option market makers, option traders have been burnt to a certain extent by some of the rallies, more so than market participants in Canada. Whereas in Canada, you've always had a very sort of flat, very asymmetrical skew, because there weren't a ton of natural sellers of below market options, protective puts. Yet there have always been good, reliable sellers, whether institutional or retail, of above market calls. That's just always been a feature. That had always been a feature in the US as well. But I think with the rampant speculation that we saw in the US, I think those sellers are demanding higher prices. They're still there, but they've gotten more price sensitive. And that's why you'll see what we like to call the smile. It always, call it I wrote something, we called it, the end of the Elvis smile, because we always called it, or can't do it, but it's sort of, Elvis sort of had that twist on one side versus the other. And the smile is getting more symmetrical in the US, whereas in Canada, it still remains more lopsided, shall we say. And so this is an interesting feature to watch, in terms of, and it has implications for call writers and for protective put buyers, because you can see there are, not only is the US trading at, let's say, an absolutely higher level across most of the curve, there's definitely differences in skew, and this is the kind of thing that option traders look to exploit. And when I say that option traders look to exploit it, that doesn't mean professionals. Individuals can look to exploit that as well. It would tell me, all things being equal, Canada is a cheaper place to speculate on calls, if you were going to do so, or less rewarding if you're a call writer on balance.
And I think this is fantastic insight because the smile was a result largely from the '87 crash when option market makers realized that they needed to uh, ask for a higher premium, effectively a higher vol, to provide protection on the markets because that crash largely made them realize that stocks move down much faster and much more violently than they move up, and we have that, what we call that volatility smile from that '87 crash. But this year, we with the proliferation of retail volume buying these short dated out of the money call options, that has really changed the game a little bit in terms of on the call side, right? That's exactly what you're referring to here, and I think that's exactly I think that's fantastic insights into understanding, as a Canadian investor or as a US investor, when you're looking at these types of names, where are there better, or where does a skew work in your favor here? And what you're telling us here is that when you're selling calls in the US, such as selling cover calls, you're going to get a little richer premiums now. And then in Canada, if you're buying calls, they're a little cheaper now. So if you're buying calls, you might be finding that they're a little cheaper in Canada. If you're selling calls, you're going to find them you're going to get a little bit more premium in the US. And I think that's fantastic insights into just the change or the relationship that we've seen market makers shift the markets a little bit this year.
Absolutely. You know, the, I 87 was, certainly a seminal moment for many traders, and really I would certainly say one of the absolute seminal moments for the option business. Because remember, in '87, one of the things they were selling, you weren't in the markets then. I was, that was like really one of my first days on the floor at Solomon Brothers was the crash.
Wow.
And one of the things that investors had been sold or told was, you can use futures as a hedge against your stock portfolios because they always, there's always a bid in futures, and you can always, you can move because of margin differences. You could always move more futures than you need to, until of course the bid dried up in the futures, and the people who had not necessarily put the skew into options, got blown up, and then people realized we should, hey, wait a minute, perhaps we should, if we want to hedge, you need to have some of the options, and you had to induce sellers because it's not like there are a lot of natural sellers of that of the money puts. And so you needed to induce that. And for years you had the lopsided nature. And I do question to what extent, and I will assert to some extent this is here to stay, that 2020 taught the option market making community and option customers, hey, we can get a little more money, Gesundheit, we can get a little more money for our calls. There've always been natural writers of calls, but there've been, the supply demand has shifted. We'll see if that persists, but I think the demand for a little extra premium, never hurts to ask for a little bit more if you're the writer. And that's why I thought this would be very useful, for the viewership today, just to get a sense of how you can find relative opportunities in terms of where to write versus buy options.
Absolutely. And I do think that GameStop in itself had something to do with this as well, with the rampant out of the money call buying, where market makers also potentially had some substantial losses selling those out of the money call options and perhaps not being able to hedge those immediately.
Oh, absolutely. But GameStop being such an outlier event, I think it actually started with SoftBank in the summer, in August,
Mm,
September,
right.
where they were sort of the gamma whale, so to speak. And GameStop being the crazy stepchild of that. But I think in terms of a secular, but they all play in. If you've been, if you've touched the hot stove, you're not going to do it again. Or at least, in the case of traders, since they do touch the hot stove over and over again, they're at least gonna be a little more cautious about how they do so.
So the takeaway from that is, again, right now, at least from looking at the curve, selling calls in the US, getting a little bit more premium, buying calls in Canada, quite a bit cheaper compared to the US. So let's talk a little bit about economics. We continue to see US economics surprise to the upside fairly strongly. Jobs report last Friday came out substantially stronger than expected. And a very large chunk of that job growth was from services, specifically leisure and hospitality, which is the segment of the market we've been looking for that recovery in order to confirm where equity markets have largely already priced in over the past few months, kind of being optimistic, looking forward looking. We're starting to see some of that data come in where it confirms the fact that equity markets have priced these things in. We're also starting to see the same here in Canada. Manufacturing continues to surprise here to the upside. Consumer confidence, we saw a huge spike in consumer confidence here in Canada. Overall, I'm guessing your views here are roughly the same in terms of just the economic recovery is taking shape, and the data so far looks fairly constructive for equity markets to potentially look even further towards the second half of the year and looking fairly positively.
Absolutely, well said. I mean, I concur with you on that one. So I wish we had more grounds for disagreement, so we could have a little more debate on it. The one thing I'd say it's fascinating is how quickly Canada has recovered, despite the fact that it's still a bit more locked down than the U.S. And so I think that actually you can argue there's even more room for animal spirits, whatever you want to call it, in Canada than there is in the U.S. But so let's see where it goes. I mean, this is to be expected. It's a good thing. The question is, how long can we sustain these good feelings? But I think for a little while, as long as they don't get too crazy, I think we're right to see this kind of enthusiasm, and it's way of filtering through.
And the thing for me that jumps out is the fact that as equities largely rallied from the beginning of November to, let's just call it mid-February, during that time, economic numbers were slowing down. We were seeing a deceleration in many of the economic numbers coming out. And March was really the turnaround. March was the surprise to the upside, both in the US and Canada. So I do think that, it does look fairly strong here for Q1 and start to look fairly strong here for Q2. Q2 likely being the strongest quarter we're probably going to see here in 2021. So for those reasons, I'm fairly positive here for what we're likely going to see here in Q2 for equities, looking a little forward towards the second half.
May I just interject for 1 second? Remember, monetary policy and fiscal policy operate with a lag, and you usually see it about 6 months out. Now, the monetary policy hasn't really changed, but the Fed and other global central banks have definitely had their foot on the accelerator, at a pretty steady and quick pace for some time. And then on top of it, you now have really what's percolating first is the last round of stimulus, and now the second round of stimulus is percolating through now. So that really does all tie into the second quarter. The question is, is that more or less a sugar rush right now? And that's, I think, a risk to the markets, because part of my thinking has always been I'm sort of most nervous when things are so wonderful, and that's kind of the spidey sense as a trader.
Yeah, and I think the fixed income markets have been expressing that largely for the past few months as we've seen this sharp rise in rates. That's why we have the Canadian 10-year yields up on the screen. Steve, I think I looked into the last session that we did, which I believe was on December 7th. So roughly about just shy of 4 months ago. And back then, the Canadian, when we looked at this particular chart too, the Canadian 10-year, and that was trading around 74 basis points. We're now basically double that, 148 basis points. And that's still after pulling back when it got all the way as high as 168 basis points here. What's your views here on interest rates? From my perspective, we had this huge breakout here above that, let's just call it 80 basis point resistance level here at the beginning of the year. We've had a very strong rally since then. I'm not sure that this is done, but we have seen a fairly strong consolidation here over the past month or so. I think that there could be a little bit more upside, at least when I'm looking at the US rates. The US 10-year, I'm expecting that it can get up as high as about 185, 190 in the next few weeks. I'd like to hear your thoughts on, interest rates, and because it has had a fairly significant impact on U.S. equities, specifically the higher beta names. It's caused a revaluation or multiple contraction in some of the higher beta names. What's your thoughts here for Canada?
I think, my view for Canada is similar to that in the US and much of the world. I mean, um, so the Fed, and I'm just going to use the Fed as a proxy for most of the world's central banks, but I think you can argue the same. The same applies for ECB and Bank of Canada, the Chancellor of the Exchequer, et cetera, et cetera. The British, the British government as well. They want inflationary expectations. They want inflation back in the system. Well, how do you express inflation and inflationary expectations? I did some work which I put out on our website today. You can see it behind me. Basically, because I happened to be doing an appearance in Australia yesterday, so I figured between Australia, Canada, I'd look at gold, commodities, CRB, et cetera, et cetera. And CRB has been steadily zooming. And basically, for the most part, and I know we're going to talk currencies later, but for the most part, the Aussie dollar, the Canadian dollar had kind of kept pace. And then you just had to sort of have this rampant, this run up over the last 6 weeks, which, by the way, coincides with the backup in rates. And I think that's inflationary expectations percolating in. And as a lot of times what we like to say is that's a feature, not a bug. If you're the central bankers trying to get inflationary expectations into the system and have promised not to raise rates or tighten monetary conditions until or unless you see that. I mean, Lagarde basically came out and dared the trading world to take us on in terms of our inflationary bets. There was some concern, there was some talk, I remember, the Fed isn't going to want the US 10-year above, pick your number, 75 basis points, 1%, 1.25%, and then we went right away to 175. And the US 10-year and the Canada 10-year have been, more or less tied at the hip. We're seeing CRB zoom. We saw interest rates rise, bond prices fall. They're related, and this is what the central banks want. So, at some point, there's the biggest component of longer term government bond yields is inflationary expectations. That's exactly what if your mantra is don't fight the Fed, or insert central bank here, don't fight the whatever, but don't fight the Fed. This is what the Fed wants. And so are they going to stand in the way of that? And so it makes me reluctant to tie up money for 10 years, by the way, which still has a negative real interest rate, which still has a negative real yield if inflationary expectations are to be believed right now. Why would I want to do that? And so that, I think, is, that's another one of those things that, because all things look so good, that's one of those sneaky headwinds that's out there. Can you get from the 160 level to 2.5, 3? Possibly.
Yeah, I think if you listen to Chairman Powell and what he's said over the past few months, that's my belief that things are going exactly the way that he wants it to go, and interest rates, in my opinion, can go higher, potentially as high as 220 in terms of on the 10-year yield in the US. And Canada, that probably translates to in the 175, 180 range here to the upside. And I drew here a fib level I don't use fibs very often, except for very long-term charts here. So we had a move from about 260 basis points at the end of 2018 down to a low of 42 basis points. We have retraced exactly 50% of that, which gets us to about 150 basis points. I'm looking for an extension up here to 177 basis points here to the upside. So that's how I'm looking at this from a technical perspective. But that largely lines up with the fundamental views that I have here as far as where these central banks are willing to let interest rates go to. And you're absolutely right. There were a lot of talks when when the US 10-year was getting up to that 100 basis point level of don't continue to sell bonds because the Feds are going to come in and start, the Fed's going to come in and start buying. And that's largely, we have not seen that at all. So they have not moved further out into the curve, into the 10-year, and they have not defended these. So I completely agree. And so this has impact on equity investors, right? When we're looking at equity investors, where do we position here within the risk spectrum of equities? Because for the large part, we've been in the higher beta tech names for the past year. With this recent rise in rates, does that shift? I certainly have shifted quite a bit towards more defensive plays, more value-based plays, financials, those types of names, lower valuation plays at the moment. And I think that will likely continue here for the next at least 3 to 6 months, in my opinion.
Yeah, I mean, one of the things that I kind of struck me was, as people were rotating out of the, let's say the tech names, because because you had bond rates rising and because you could no longer essentially discount at zero into infinity. It's like now all of a sudden valuations matter, but I guess they did, and ultimately, that is going to come into play. The only comment I would have is, I love that you put the Fibonacci lines on the chart on the left. The problem is we're not necessarily dealing with I've got to choose my words very carefully. There's a very strong hand behind fixed income markets globally. And so, whereas technical analysis, I find, tends to work very well in the absence of other interference. I will first stipulate that I think that the world central, as we said before, the world central banks are hands off right now on the longer end of the curve. Do what you're going to do, with the exception of Bank of Japan, and the ECB's kind of doing interest rate control in the back. I think in the mind of a lot of bond traders, what they used to call the widowmaker trade was shorting the Japanese 10-year, because ultimately, it was going to have to go up, and for decades it never really moved, and so ultimately you'd short it and it would never work out. I think at least in North America, the central bankers are not quite as resolute as the Bank of Japan about keeping the long end of the curve contained. I think it's an impossibility unless you involve yourself in the curve to such a great extent. You really can't have higher inflationary expectations and incredibly low long-term rates,
Right.
until or unless you're intervening in such a huge way. That's my problem with some of the technicals, is nothing says they can't.
Yeah, I completely agree. I use the technicals only on this to get a sense for price targets to the upside, but the directional view still has to come from, as you say, looking at more of the fundamental picture, if you will. Now, but let's shift a little bit to the lower end of the curve, the 2-year. I'm looking at the 2-year differential between the US and Canada, and we've seen this compress down into negative rates again here for quite some time throughout 2020, but we're back just shy, or looks like we're still This is US minus Canada. So this is, we're just around the zero. We're at -7 basis points right now in the differential between US and Canada. And this has ramifications for dollar CAD, right? We started to talk a little bit about dollar CAD. And one of the main drivers of currency flows is the interest rate differential, which right now is largely flat, but still slightly negative here for Canada versus the US. Thoughts on the dollar CAD, because you were talking a little bit about dollar CAD here yesterday. It's approaching that 125 support level. What's your view here on this?
Well, I think, right now, much of let's say the 2021, the later part of the leg down has pretty much coincided with a rise in CRB. I allude to something that you guys can find on the web that I put out today. I don't have the URL handy in a quick way to relay it, but it's there. And I think for the most part, Canada has tracked to some extent the rise in commodity prices. For all the reasons that all of us know about, Canada's perception as a commodities, commodities having a relatively high importance in the economic output of the country. We did not see that, let's say, over the last 6 weeks, but I think that difference is more explained by what we just saw in the bond market chart than what we're seeing in the currency chart. I think, right now you've sort of taken interest rate differential out of play to some extent because, thank you for sharing that, Tony. You've sort of taken that interest rate differential out of play right now because, neither central bank seems to have any gut interest in getting negative rates. Neither one also seems to have any great interest in raising rates anytime soon. The implied next, going out 2 years, at least in the US, the Eurodollar futures are basically implying minuscule chances of an interest rate rise. At least as of now, they're taking Chairman Powell at his word. We may learn a little bit more about that when the minutes come out later. I think, what's taken the US to a little bit lower yield than Canada is just there's more demand systemically for US risk-free assets than there are for Canadian ones. It's a more diverse banking sector, a more diverse financial sector. So you have more of a need, just greater worldwide demand for the US, for US money market and short-term fixed income instruments. So I think getting back to the currency, I think if we can start, if, and these are two huge ifs, if we see bonds kind of find their level around here and we continue to see commodity demand, let's say reflected in CRB and some other stuff, I think you're really going to get a very strong test of this 120, 125 range on CAD. If not, if the slack is sort of taken up by rises in the bond market, I think it's going to have, you're still going to test it, but it'll be a little bit of a tougher churn to break through. I think that's where it comes from. The wild card again is, as I alluded to earlier, the US is further along in the reopening process than Canada is. And so that also could have a bit of an incremental benefit to CAD relative to USD going forward. I'm pretty sanguine on the Canadian dollar right now, although I think the easy money has been made. Each of the support levels, though, have proven to be far from insurmountable. I remember us talking about that were fairly bullish. You were more bullish than I, and I give you a lot of credit on that one because I thought the 130-ish level was going to provide a bit more support or resistance, depending on which way you're looking at it. Then it did, and went right through that one. And I think 120 to 125 is going to be a bit tougher to overcome just because of the long-term technical nature of that.
Right. And you mentioned commodities. So let's shift over to taking a look at oil a little bit. we've been tracking oil for quite some time. We've had that significant rally here from the low 40s up until 66 on U.S. crude. And one of the things that we were warning investors about was the last few pushes higher that what felt like oil moving fairly parabolic throughout pretty much from mid-February through the mid-March. We saw some major negative divergence started to show up here on the technicals, and it basically resolved itself in a single day. That one day when crude was down about 7% back into that $60 range. And typically when we see this type of big move to the downside, they're typically followed by consolidation periods. And that's exactly what we have seen here over the past 3 weeks or so, 2.5 weeks or so, where crude has basically moved, it has been very volatile actually, up and down quite a bit throughout the days, but largely settling around the $60 level here to the upside, to the downside, kind of finding a bit of equilibrium here, I would say, for between demand and supply on crude right now.
Yeah, I mean, I think, I think $60, I mean, if you look at the longer term chart, that was sort of the equilibrium level more or less for quite some time. There are reasons for that. I think that's kind of the level OPEC enjoys. I think they realize that they don't want it to systemically go too far above 60, which is, and the reason being Canadian oil shale. They really, sorry, those of you who are invested out west, they don't want it to become too profitable. It's a real competitor to them. So if they can to kind of keep crude at the high end of where it's profitable to most of OPEC, who are lower cost producers, but keep it marginally profitable at best to North American oil shale and fracking, that's kind of the level it settles into. Remember what I said before about bonds not really being that there's larger hands, intermingling in the market. Well, OPEC is it's not exactly a secret what they do, and so I think that's why I think we kind of revert to this level, even as the economy strengthens, even as we we see increased demand for travel. Hey, they're talking about cruise ships getting going again. They eat a lot. They eat a lot of fuel oil, and people need to fly planes to get to the coast if you don't live near one. But I think we kind of have the market sort of defined for us around 60, and means you'll have trading opportunities as you noted.
Yeah, I mean, implied volatilities on crude is still not particularly low at the moment. So, we've been trading calendar type strategies on crude or type of energy names, looking for basically a contraction in volatility and just more stability around the $60 level. Those are the types of option strategies we've been taking a look at. So let's switch gears a little bit and start talking about some of the specific industries within Canada, financials being one of the top ones, one of the best performing sectors for the past 4 or 5 months or so, with the exception of energy. But we largely have seen energy slow down here in terms of momentum in a fairly significant way over the past 3 weeks, 4 weeks or so. Financials are still holding in there. And I think what's interesting about financials is that, for me, there are two main drivers here for financials. One is interest rates. We were just talking about that. Not only the rise in rates, but also the steepening of the rate curve, and also the economic recovery continuing to take shape. Banks largely have been fairly cheap from a valuation perspective. So as the economic recovery starts to take shape, and what's been really, I think, interesting for investors to kind of start to realize as over the past 4 to 5 months is, in the beginning of the pandemic, we were expecting potentially a huge disruption to credit markets in terms of defaults, in terms of loan delinquencies. There were a lot of concerns around that, and that has largely been untrue. And actually, we have seen those numbers fall, default rates, loan delinquencies, and that has provided a pretty big boost here to financials here as well. So for those reasons, I think financials, even if interest rates have a little bit more upside, maybe not a whole lot, much further to go. I think banks still have a potential further upside just on the economic recovery and the shape of the recovery that we're continuing to see.
Yeah, I mean, if you're betting on a stronger economy, there's so many different ways that a well-managed bank can benefit. The Canadian banks have always been, considered well-managed. I guess the knock is that they can be, a bit sleepy. And from a user point of view, I know, so that you don't have to put it in the chat. I know it's expensive to be a banking consumer in Canada in many cases, but that, you if you can't beat them, join them, is what I've said various times. And if it's an expensive place to be a bank customer, probably means you want to be investing in the bank. And so there's a lot of ways to play this. And if you do feel that the risk to equity valuations largely comes from interest rates, if you feel that that comes from the long end of the curve rather than the short end of the curve, it continues to be a place to play because, as you noted, banks are in the business of playing that spread. They borrow from you in demand deposits and lend it back to you and others in longer term loans. Canada specifically, we've been hearing about the interest worries about the housing markets, and of course the Canadian banks are in many ways uniquely exposed to the Canadian housing market. And I have not tried to buy a condo in Toronto or in Vancouver, but those prices have continued to benefit, and I do have to wonder, in the case of the Canadian banks, who are who have a lot of concentrated exposure to Canadian house prices, if you get a high enough interest rate so that it puts a lid on affordability, does that sort of work against the benefit of the spread? But as of now, and I see the question popping up, I know real estate has been on fire in Canada and elsewhere. On the other, yes, there's definitely a risk that can accrue from that. But people have been looking at this risk for years now and saying, oh, this is a ticking time bomb. It could be, but nothing has set that bomb off yet. The thing that could is sustained higher interest rates that could impede the most recent crop of borrowers, and that mitigates the benefit that you see to the banks from the interest rate curve. But all in all, probably not a bad place to hide.
Yeah, I think that risk is absolutely real, but I also have seen that narrative play out in other economies, like, for example, Australia, for about 12 years now, pretty much since um, the 2008 financial crisis. We were talking about how household debt in Australia and the banks are largely exposed to real estate as their primary risk. And there have been concerns since 2008 that rising interest rates would cause that to effectively collapse. And a lot of wealth in Australia is tied to real estate, so largely to what we're seeing play out here in Canada. And it has not played out. That doesn't mean that it won't play out. That doesn't mean that down the line, these risks aren't real. The question is timing. And you could have, and as I think there are many ways that you can express this, but I think the most common way that people say is the market's going to be irrational longer than you can stay solvent, right? And then this is really a use case for options. The way that I think about playing trades that I think still have further upside, but I am concerned about, one of these, let's just call it a bit of a black swan or a bit of a tail event here to the downside, one of the ways that I try to protect myself from those events is by using options to express my bullish views. And especially if we talk about call options being relatively inexpensive here, let's just look at XFN. And I have two trades up here that are interesting to take a look at. First of all, I'm going out to September, buying myself a little bit of time. This is almost 6 months away. And I'm looking at two call options. So XFN is currently trading just shy of $44. If I buy a $40 call, which is a call that's about $4 in the money, it only costs me $4.20. That has a break-even cost of $44.20. That's effectively the current price of XFN. XFN only has to move about 30 cents higher from where it is right now. That's less than 1% for this to break even by September. And I'm paying $4.20, which is just shy of 10% of the ETF's value. So if you're concerned about, a tail event, you can protect yourself by using a call option like this, which is very similar to a stock replacement strategy. So you're effectively buying, or your position is very similar to owning the stock at about 10% of the cost of buying 100 shares of XFN. Or you can look at buying an at the money call option, as Steve was showing us before, that Canadian implied volatilities are inexpensive. Buying a September $44 call is only $1.50. This does have a significantly higher break-even price, 45.5, so about $1.60 above where we are right now. So about 4 or 5% higher. The ETF has to move about 4 to 5% higher here over the next 6 months for this to break even, but you're only paying $1.50 for it. So you're risking only about 3-4% of the ETF's value to play for that upside. So depending on how much risk you want to take, you really have quite a few options here to gain upside exposure while limiting your risk or limiting that tail risk to the downside.
Yeah, I mean, there's the beauty of options is there's so many different ways to skin the cat, so to speak. I mean, what you're talking about here is more stock replacement. Obviously, there are situations where a well-capitalized investor, and I use that term very carefully, can enter a position through selling cash secured puts. As we noted from the skew differential there, you might as well take advantage of that. There's so many different ways, and I like what you suggested here. Is it's the beauty of options is if you can control your risk so well. In the case of the XFN strategy you mentioned, you've defined your risk before you've hit send on your order. It's, that's a wonderful thing. We could go into it so many different ways. There's so many different ways to play it based on your level of knowledge and risk tolerance and capitalization. I keep coming back to that, but the one thing that scares me most right now is that people, hopefully no one on this call, have been getting a bit out, what I'm going to say, getting out over their skis a bit too much. They're a little, not considering all the things that could go wrong. Whereas, if you're buying a call, it's a very defined position. But just make sure you understand what, when you see that weird little tail on the graph there, you better make sure that you're not exposed to that weird little tail on the graph in a negative way if you can't afford that.
Right. And, to your point, as far as options being, there are many ways to skin the cat. There are so many ways that you can utilize options and variations of combinations of options to create spreads, calendars, diagonals, vertical spreads. The one thing that I will say is, as complicated as those strategies may sound, especially for those of you that are starting out, remember that they're all built on the fundamental building blocks. And there are 4 core strategies. You can buy a call, you can buy a put, you can sell a call, and you can sell a put. And all of these more advanced strategies are based on these four fundamental building blocks. So if you find those complicated, all you have to do is first take the time to really make sure you understand those four core strategies. If you can understand those four core strategies, you can effectively reverse engineer and work your way back into understanding these more complex strategies. So as if it's your first time, if you're starting out and you feel a little bit overwhelmed by some of those complex strategies, don't worry. We have quite a bit of education here at Options Play where we break down those four core strategies and make sure you really understand them, what the difference is, what you're really expressing when you're buying a call, and how that differs from selling a put as bullish strategies, and vice versa if you're bearish, buying a put versus selling a call, because they are very different in nature, but they're also mirror images of each other. So once you understand a call, puts become fairly easy to understand because they're a mirror image for bearish views versus bullish views. So, largely, I think the main difference is understanding buying a call versus selling a put. If you can truly understand the difference between those two strategies, you have a very good starting point or very good foundation that you can build upon to understand these more complex strategies. So with that, Steve, Keith is asking a really interesting, really good question. I would like you to help me answer this question. Because XFN and the banks pay a large dividend, Keith is asking, how does XFN dividends affect the long call price? And I think as a market maker, you are very well suited to help answer that question.
Yeah. Well, there are various inputs to option pricing. And one of the things that you need to keep in mind is that options are priced off of the forward value to that date. So if you're buying an option that goes out a couple of months, the price of the stock is not necessarily the spot price that you see on the screen. It's adjusted because when you're using the time value of money, the forward value is typically a little higher. Right now in a zero interest rate environment, you can largely ignore that. But I think that the zero interest rate environment does a disservice to people who are new to the option market, because I think you gloss over that fact, but it's there. So it's increased by interest rate differential, unless the stock is hard to borrow, in which case then that forward value is depressed. And one of the other things that depresses the forward value is interest rates, and dividends. And so, if you take, what you're going to do is you take a look at the desired expiration of your call option. And if there is a dividend between now and then, the price typically reflects the fact that the forward value will be diminished by the dividend. And so markets markets understand this. It also requires, if you're going to buy an option over a dividend period, it requires a bit more vigilance on the part of the holder, because you better make sure that you exercise that that an in the money call before the ex-dividend date, on or before the ex-dividend date, to make sure, before the ex-dividend date, to make sure that you get to keep the dividend. The little rule of thumb I use is, and this goes back to Tony's building blocks, is I will exercise an option if the dividend is greater than the put on the corresponding put to the call that I have. We can get into the math on that one. Just trust me on that one. But basically, it's very important. The options community is pricing in the dividend, but then it is up to you to exercise in a timely manner. Otherwise, you kind of find yourself out, because what will happen is the value of the stock, all things being equal, will be diminished on ex-dividend date, and you don't get to participate. If you do exercise, you do get to participate. But that also comes back to understanding your capitalization. You have to have enough money in your account to buy the stock if you exercise the call. So there's an extra challenge to it, but markets are reasonably efficient about it. But it requires, it's very important that you see that if you're trading across an ex-dividend date, so you really have to know your ex-dividend dates. You really have to follow these things. And it behooves you as an individual to trade options on stocks that have well-defined patterns of dividends, because it gets, one of the things as a market maker that would drive us crazy would be a company that would move its, routinely move its dividend around an expiration, which completely messes up your pricing. So there's an extra set of challenges, but it can be done, and it's the options reflect it, but realize that it's going to change the forward price, the forward price of the stock on which your option is based. I hope that answered the question without being too technical there.
I hope that also answered your question, Keith. We do have time for just a couple of questions here. So if anyone has some questions, you can type them into the Q&A section at the bottom of your screen. But before we wrap up, Steve, I just want to give you an opportunity to just talk a little bit about Interactive Brokers and where they can find out a little bit about your company and the work that you do with Trader Insights. And before we wrap up with just one more question.
Sure. I mean, interactivebrokers.com, interactivebrokers.ca for those of you in Canada. We've always prided ourselves on being low cost, high access. You get, one single account basically gets you the world in terms of market access and in terms of types of product. It's one account that gets you commodities and futures and stocks and options. And so, this is a huge advantage. A couple of questions have come up. I did answer one in the chat, and I just saw another one come up in the Q&A. Yes, we do offer multi-leg orders on Canadian markets. They're there, and someone asked, how do I insure it? There's a complex order type. I don't really have the opportunity to go into it here. But you can enter things as a spread, and then trade it that way. So if you want to do a vertical call spread, for example, you'd enter the 40 and the 45 calls as a complex order type and place one bid ask that lets you trade both without the execution risk. One thing that Tony alluded to at the top of the call, and I'm going to harp on this as an ex-market maker all the time, is don't be afraid to test the markets with your orders, whether this goes for complex or single orders in Canada or the US, because, okay, so there we go. So you'll see in the XFN order that Tony just highlighted, you've got a relatively wide spread there, over 40 cents on a $4.20 option. You don't necessarily want to do that, but realize that whoever's the midpoint is the key here, because basically whoever's going to sell that option is valuing, the market's telling you that the fair value of that option is $4.20. People are not going to trade with you at fair value. That's just not going to happen, because the role of the buyer and the seller, the role of the professional buyer and seller, the market maker, is to buy it below the fair value and sell it above the fair value. But what that also means in this example is there's probably a place in between 420 and 438. I'd almost guarantee you, but I can't do it with 100% certainty, but I'd almost guarantee you that somewhere between 420 and 438, there will be a price where someone will sell it to you. Whether that's 425, as you wrote in the screen, that might be a bit tight to the spread, but you could try I would say if you bid 435, you're almost definitely going to get hit. I would say if you bid 430, you have a pretty good likelihood of getting hit, assuming the underlying doesn't run away from you in that situation. Try it. What you'll find is market makers don't always put their best prices on the screen all the time, and in a very busy US option, you don't really realize that because the spreads look so tight, but that's just because so many people are posting bids and asks. In Canada, where there's a smaller market making community, they'll tend to be a bit wider. The reason why you never post your best bid and ask across all the strikes all the time is it's too much risk. If something were to move and you aren't fast enough, you could end up getting taken on hundreds of calls across all your strikes, and you can't have that happen. So you always leave yourself a little margin of error. And so and you as the customer can take advantage of that. You can try in this situation, whatever you want. You could bid 4.25. odds are you're not going to, if it's not a large order, the 438 offer is probably not going to move. They're not just because, Joe in Saskatchewan is bidding, 4.25 for a 5 lot. I better move my price. That's not going to happen. They may ignore it. And you can try and try again. If you bid 4.25 for 500, yeah, they're probably going to move their price. But if you're trading in 10 lots or less, they want to interact with your order flow. But nothing says you have to do it at the price nothing says you have to do it at the price that the market maker is showing on the screen. You can try it, and they have software that's scanning this for these situations. And I can't tell you, I don't know where each market maker has it set, but I will pretty much guarantee you that whoever's on that 438 offering, if they see that the bid is 420 and there's a chance to make certain number of cents above 420, they're going to take that opportunity if they wanted to sell that option. So use that to your advantage.
I'm really glad that you're here, because this is a conversation that we have quite often here at Options Play, talking about this spread. Because, when you see the bid and ask price, it's kind of like walking onto the car dealership, and that's a sticker price that you see on the car, right? That's what, they're not quoting you necessarily the best price. Now, the challenge with the car dealership is that you don't know what the car dealer paid for that car. So you're kind of negotiating in the dark, right? Maybe the sticker price is $30,000 and you're guessing that the car dealer paid $25,000. So you're trying to offer him somewhere in between there, $26,000, $27,000, $28,000, less than the sticker price, but more than what they paid for the car. But what's interesting about a two-way market is that you effectively you're getting a bit of a glimpse into what the market maker is calculating as the fair value of that option. That's what the mid price is largely giving you some sense of. And you can negotiate around that, because as long as you're giving the market maker a markup above the fair value if you're buying, and below the fair value if you're selling, that is where you have the ability to potentially get the better. And I think, Steve, the insights that you provided, that I think is very important for investors to understand, because investors many times will complain that this spread is too wide. And I don't necessarily disagree with that when you look at that on the screen, right? I wouldn't want to pay 40 cents to get in and get out, 42 cents to get in and get out of that trade. But you said one thing that was very interesting, and it provides a different perspective for investors who are looking at the screen to think about the other side, because the other side is posting quotes not only on this one option that you're trying to buy or sell, they're posting quotes on all the options across the entire chain. And if, let's say, there's a fast moving market and they have a very tight quote up there, they could get taken out across the entire chain by another market maker or another high frequency firm, and they could leave themselves exposed to doing so. And that's why they don't post their best possible bid and ask quotes, because they're concerned about that risk. And so that gives you some insights into why market makers post these wider quotes. But again, by putting a limit order for a specific option, that tells the market maker, I want to trade this one product. I'm not trying to lift the bid on the entire options chain for this one symbol. That is why the market makers are open to negotiating, if you will, and executing your order, because at the end of the day, they want your order. Because that's how they make money. If they don't get your order, there's no money to be made.
That's the thing that gets lost on people a lot of times is, the market maker moved. If you don't trade, you don't make money. One of the things we used to say, a lot of times people would want to be widening their quotes and things like that. And it's like, great, you could, because I don't want to take that risk. And it's like, great, I could assure that you take no risk, if you never do a trade. But if you're a market maker, you're out of business, because you can't. What do you do? Your job is to try to buy the bid, sell the offer, and do it over and over again, or at least hedge it out. And so, bear in mind that retail order flow is exactly what the market maker wants to interact with. And let me not say, sometimes you hear it, smart money, dumb money. No. I believe that that no matter how big the order, it has every reasonable chance of of working out for the other side. I may make money, I may lose money on that one. The difference is if I'm trading with someone who moves at the speed of a human versus the speed of thousands of orders that could come through a machine, I'm much more willing to negotiate over that because you know, I might lose money selling you that individual option, but you know, I may have been able to hedge it with a different option or bought the stock or whatever. And it's not trading is not necessarily a zero sum game because of differences in time frame, time horizon, ability to hedge, whatever else. So you know, we can go into the various permutations, but the bottom line is there's room for both sides to make money and take advantage of that. This is what the market makers want. They'd rather you pay the sticker price on your car, but they'll sell you the car. They'll sell you the car if you're willing to pay. You know, remember, it doesn't matter what they paid for the individual option. It's what, you know, everybody's got the discipline of the fair value is what the fair value is. And so you think of that 420 right now as that's the fair value. So if you can make a little bit of a profit over the 420, sufficient profit, out it goes. And then you know, and this will happen. Same with selling. Try your luck at selling it above the bid. See what happens. And you'll find effectively that means that the market is tighter than it appears on the screen. And by listening to this webinar, you should know that and utilize that fact.
Well, I hope that everyone here that is listening found that insightful and giving you a better understanding as to just how the other side of the equation works, how the other side of the screen works, to give you some insights, because the more you understand about that, the more you are informed to be able to place orders and get filled at better execution prices than what you see on your screen. So with that, I think that's a good place for us to wrap up here. Steve, thank you so much for your time here today. I hope everyone got something out of this, whether it's around understanding of the markets, where we currently view the markets, but also some thoughts around executing, which is a large part of the feedback that we receive from Canadian investors. So I hope that you were able to take something from that. So with that, Steve, if you have any closing statements before we wrap up here for today.
Not necessarily. I thank you again for having me, Tony, and thank you to TMX for you know, hosting this. I think I've answered many of the questions. If we can leave it up for like a second, there's a couple more that I'm typing answers to where I can. You know, thanks, and I appreciate everybody's time and attention who joined us today.
Yeah, and I will post a link here to Steve's, to the Trader Insights on Interactive Brokers here into the chat window if you want to take a look at the posts that Steve and his team puts together every single day at Interactive Brokers. It's a great way to get insights into how market strategists like Steve think about the markets. So I'll post that link here as well, and we'll include that link in the recording when we send that out here in a couple of minutes. So with that, thank you so much. I hope everyone has a great trading day. And Steve, thank you so much.
Thank you, Tony. Always a pleasure.